Okay, guys, this is AAT Level 2 Introduction to Bookkeeping, Lesson 1 Financial Transactions and Records. The learning outcomes for today are to be able to identify key business financial documents, be able to outline the stages of the bookkeeping process, and to be able to give a general overview of the books and ledgers within a bookkeeping system. Now, first thing you have to understand is that business's sole purpose is to make money, no matter what they tell you. And that is how you are important to a business as an accountant, because in order to be profitable as a business, you need to be able to record your costs and also record your revenues to be able to work out your profit. And this is what has created the bookkeeping system, a rigorous process in order to make sure that you keep everything in check, basically. And there's 5 stages to this in the bookkeeping process, in the bookkeeping system process. The first stage is financial transactions, and the financial transaction is basically anything. You see these occurring every single day when you purchase something or when you sell something. And when you purchase or sell something, a financial document is actually created. You may not see this, but it actually always is. And for example, if you purchase something, you usually get a purchase invoice, and that's the financial document that is created. So from a financial transaction, a financial document is created, and this basically makes a trail for every single financial transaction that occurs, which the accountants then use. From that, from the financial document, the transaction is then recorded in the book of prime entry. So the book of prime entry is where financial transactions are first written down, and it's the very basic level in the key stages, on the bookkeeping system stages. And it's simply put, like for example, there's different books of prime entry which you're going to learn about further in this lesson. But for example, there is a sales day book, right? And the sales day book will record all the sales. Then there's a purchase day book, and that will record all the purchases. But it's in a very simple, basic format in terms of there's no double entry in the book of prime entries. And so, for example, it will be listed like this for sale. For example, sales day book, each sale would be written down. So, for example, customer A bought £500 worth of baked beans. Customer B bought £200 worth of baked beans. Simply like that. Same thing with purchases, right? But these are different books, so different transactions will have different books of prime entry. And then this is advanced into the later stage into the bookkeeping system, right? Which is the ledger accounts. And as it's transferred to the ledger accounts, it uses something more advanced called the double entry bookkeeping system. So the books of prime entry don't use a double entry bookkeeping system, but the ledger accounts do. And I don't want to get too deep into this because we want to know how to walk before we learn how to run, right? But I'm going to give you the gist of it now. So the double entry system basically means it's basically a way of ensuring that accountants are recording financial information accurately, right? It's just a way of making sure that everything is being maintained properly. And it means that every single transaction has to have, from the books of prime entry, has to have a double entry in the ledger, in each ledger account, right? There's multiple ledger accounts for different things, right? There's some for sales, purchases, expenses, assets, a lot of different things, right? So you might have a vehicle ledger account, right? You might have a electricity expense account, right? But basically, every single ledger account has to have every single transaction has to have a debit entry and a credit entry, and it will have a debit entry in one ledger account and a credit entry in another ledger account. The reason why they do this is because it's to show where money is coming from, what sources of money the money is coming from, and where it's headed to. And this keeps things in track and ensures that the accountants are doing their job properly, basically. So, in short, debit credits bring, and simply put, basically, credits show where the sources of money is coming from, and debits show where the sources of money are going to, where they're landing. So credit shows where it's coming from, debits where it's going to, right? Simply put. So for example, for the sales day book, right? The sales day book in the is a book of prime entry. And books of prime entry don't have a double entry system, but the ledger accounts do. So when this sales day book is being transferred to the ledger accounts, it has to be first first of all, you have to credit sales, which is a ledger account, right? And then you also have to debit the customer's account, which is a sales ledger account. So there's a sales ledger account for the specific customer, and that's what you debit. And then after, you have to also credit sales, which is a different ledger account. Kind of confusing, but you understand it later on. I'm just giving it to you now so you kind of get the gist of it. So later on you can see how it connects and maybe come back to this video. But the reason as to why you have to debit the customer account, which is a sales ledger account, right, is because of the fact that it's treated as an asset. So it's basically saying, this transaction is basically showing that the sale from the sales day book, right, from the book of prime entry, is being put into ledger account, transferred into ledger account, and is shown as a debit credit entry by crediting sales, which is showing, okay, cool, the money is coming from the sales, right, even though it hasn't yet come to fruition, right, but the money is coming from the sales, right, and then you're putting it into an asset, which is the customer owing you money, basically. Long story short, don't worry about it. It's a little bit confusing now. You understand it later. It's just jargon, but you're gonna understand it when we really get into debits and credits. And I'm very excited to show you what that's all about, because you're gonna feel like a whiz kid once you get this down. Next thing you have to understand is that the ledger accounts are then transferred into a trial balance, and a trial balance is basically a financial report which shows the accountants that basically it's a check marker to make sure that everything is balanced, because debits and credits have to be balanced. So as I told you before, every single transaction has to have a debit and credit entry. So there's two coins, there's two sides to each transaction, right? On like a coin. So that means that on the trial balance, it has to be balanced because it should be as much debit entries as credit entries. So basically, each ledger account, right, like the sales ledger, um, like the sales ledger for the customers, and the credit sales ledger, right, um, are all gonna have a balance, a remaining balance. So maybe a credit balance or a debit balance, and basically all these balances for each ledger is put onto the trial balance. So once that's put on the trial balance, they should be balanced in terms of, you add the debits and you add the credits and you take away from the debits from that, and it should be balanced. Basically, it has to be equal. The amount of debits and credits have to be equal, and a trial balance is basically just a way of showing that it's a financial report, a basic financial report, which shows the accountants are doing a good job, basically, and everything is balanced. That's the gist of it. We'll get into that later on. It's kind of hard to explain without showing you, but we will do that later on. Trust me, it's a process. Now, you have to understand the next thing is that after the trial balance is created, then now we can finally move on to the development of the financial statements. And the two significant financial statements listed here, are shown here, sorry. And the first one, well, it's not first or second, but one of them is the statement of financial position. And you can see this with the little locale going on the £5 note. It's just to kind of illustrate, like kind of frame it into your mind so you kind of remember it, right? I love using imagery to kind of like make it make sense and to kind of convey these ideas, but also to kind of cement in your head. So really look at these images to try and make a narrative and a story, so these ideas stick into your head, right? Anywho, so The statement of financial position, um, financial statement, the financial statement, the statement of financial position, sorry, is basically a financial statement which gives you an idea of the long-term viability of the business. So, what does that mean? It basically lists out all the assets, liabilities, and the capital of the business. The assets is things they own, the liabilities is things they owe, and the capital basically shows um it could be a bunch of things, right? So it could either be retained earnings or it could be the amount of money that the investors have put into the business from outside of the business, right? So personal wealth that they put into injected into business. And that all comes back to the accounting equation where everything has to be balanced. Assets equals liabilities plus capital. You don't need to know that now, but basically the statement of financial position just tells you how good, well situated is a business for in the long term. How great of of a chance of survival does it have? It basically shows you where the business is situated. The next thing is the statement of profit or loss, and the statement of profit or loss is simply that, it shows you if the business is profitable or not. So this is more of a short-term view of the business, Is it making money? Is it not making money? It's not really caring about how much liabilities you have, how much assets you have, your long-term potential of the business. This is very much short-term thinking. And you look at it to see if in the short term, if the business is doing well. Because usually the short term influences the long term results of the company, but you also need to know that the long term how the business is situated in the long term with the statement of financial position to know if it's even worth looking at the short term, right? Because they might be getting profits, but it's very much these profits are very much being made with highly leveraging debt, right? So that's why you have to look at both parts, short term and long term. And basically, the statements of profit or loss, in summary, is showing you the revenues and the costs of the business. And basically, if from the revenues minus the costs, if the business is making a profit or a loss. Okay, there's still more, guys, so keep alert, drink an energy drink, or maybe make yourself a coffee. Now it's the part of learning about the business documents. This is a little bit more easy. You kind of know about most of these. So you probably know about most of these. The first one is an invoice, and an invoice details the goods or services bought and how much the buyer owes the seller. You probably received one of these when you buy from Nike or whether it usually comes in your box. The next one is a credit note, and credit notes are issued by the seller when goods are either faulty or not as ordered, meaning they need to be returned. Credit notes reduce the amounts owed by customers. Now, to understand this is that in most businesses you actually buy on credit. So in this accounting, in AAT specifically, you have to understand that most purchases that you're dealing with in most of the exams and stuff, right? uh, They assume you have to kind of assume that it's a credit purchase rather than a cash purchase, unless it states it's a cash purchase. So basically, as a credit note, if for example you buy an item off me, right, and you owe me £100, I'll give you a credit, and it comes up faulty. I'll give you, but it's still in use, right? It may be like um you just want 30% back, right? Because you can't get the full utilization for the product, but it's good enough, right? So I'll give you £30 credit note, which basically reduces the amount that you owe me. So now you only have to give me back £70 rather than the £100 that we first agreed upon. And that's how a credit note works. So a credit note is issued by the seller, which is I, when the goods are either faulty or not as ordered, meaning they need to be returned, or basically you need to be restored in some sort of way in terms of I need to give you some sort of value back. And this is why it's described as reducing the amount owned by customers. The next one you may not have heard of, but it's called remittance advice. And a remittance advice is a document sent from the customer to the seller detailing what they are paying for. This is used to allocate the payments to relevant transactions. So, for example, imagine if you bought, you know, like a TV, a sofa, and a MacBook from me, right? Now, you sent £500 to me. I need to know what you're paying for, right? So that's what remittance advice is. It's basically, it lists out, it's a document which tells from the which you as a customer is giving to me, the seller, telling me what you're paying for. Are you paying for the MacBook, or do you want this money going towards paying for the sofa? Or basically, it's just basically a way of communication to let me know what you're paying for. The next one is a statement of account. You may be you may have seen this before in your day-to-day life. And it's basically a document which is sent by the seller to the customer, usually around the end of the month, detailing the transactions on the account and how much is still owed by the customer. Now, the next one is a bank statement, and hopefully, you've gotten a bank statement before. Um, I think everyone has, by this age that you're at right now, you probably have witnessed a bank statement. If you haven't, it's probably on your banking app. You should probably go look at that now. It may help, make this a little bit more solid in your understanding. Um, but basically, it's a document issued by the bank detailing the activity in your account. So basically, it shows you your balance, it shows you how much you've deposited or withdrawn from your account, and it also has a description detailing where you've spent the money or where you've withdrawn the money, and where you've deposited the money. To be able to understand what a petty cash voucher is, you have to understand what a petty cash system is. And a petty cash system, if you have a job, you may have this system in place already at your workplace. If not, maybe ask, so it kind of like, cements this the understanding of this in your head, actually seeing it in a business situation. Um, However, it describes a system where a business keeps a small amount of money in a tin. For example, it could be a jar, it could be a drawer, it could be even an envelope. But this money is used for small purchases for the business. For example, coffee, stamps, or tea for the office, or maybe like pens, stationery, stamps, whatever. And basically, the way the system works is that the employee may go buy an item, right? Like for the office, like maybe tea or something. Then a petty cash voucher is created, and the petty cash voucher has to be put into the tin or maybe like paper clipped, whatever. And basically, this allows you to be given the money from the authorized person of the business. So, for example, if you go and buy tea and you say, "Oh yeah, spend £10 for this tea for the office," can I take out of petty cash? Me as the authorizer, I'll be like, "Yeah, sure." I'll write it on the petty cash voucher, put that into the envelope, whether where I'm keeping the money, or maybe somewhere different, like in a paper clip or something, and then I'll reimburse you the $10. That's basically how it works. So that's what a petty cash voucher is. It details the amount of money that has been used up from the petty cash of the business, which is used only for small amounts of money, small purchases for the business. As I said before, I told you we are going to get here, and I haven't let you guys down yet. This is the proof of that. So, there's books of prime entry, and books of prime entries are also known as day books. Remember that. So it's interchangeable. It could either be written down as books of prime entry or day books. It's the same thing. I don't know, in accounting it's very weird. We have different terms for the same thing, but as long as you've got the understanding, it will be very easy to know and understand it's the same thing. But books of prime entries, also known as day books, are books in which we initially record invoices and credit notes. This is why they are known as prime entry books. They are the first place of recording these financial transactions, most businesses will retain the following books of prime entry: sales day book, sales returns day book. So a sales day book will be the first place where you record sales. Sales return day book, obviously the first place where you record sales returns. Purchase day book, purchases return day book, discounts received day book, and discounts allowed day book, cash book, and petty cash book. And we're going to get into each one so you have a more firm understanding of each thing, each cash book or day book. But yeah, I know some down here it's labeled books are not day book, and one of them is called a petty cash book. But they're all day books. They're all books of entry, prime entry. So just know that if anyone's bringing up books of prime entry or day books, these are what they're talking about. So the sales day book lists all the sales invoices issued. So if I have any sale and an invoice is created, I have to make sure, well, an invoice has to be created. I have to make sure that I write it down in this sales day book. It's the first book that I write in, and that's why it's called a sales day book. It's a book of prime entry. And here you see a little cafe stand, whatever, that I try to cement your understanding in it by using some entertaining pictures, because I know it could be a little bit tedious trying to learn this stuff. So I'm trying to make it a little bit more fun, you know? Next one, sales return day book. Now, the sales return day book lists all the credit notes issued due to customer returns. So, as I told you before, right, when you've returned something, because it's faulty, whatever, I then give you a credit note. So it basically reduces the amount you have to pay me. So, for example, you bought a TV from me from £100, but you haven't given me the cash, right? So it's a credit purchase. Now I give you a credit note to reduce the amount you owe to me. So now instead of you owe me that £100 because you returned the item because it's faulty, you owe me nothing because I gave you a credit note worth £100. But every single credit note that I've issued to a customer, I have to write it down in my sales returns daybook as a business. Now, the purchases daybook. The purchases daybook lists all purchase invoices received. So that is the purchases of the business. So understand this. When we're talking about sales, we're talking about customers. When we're talking about purchases, we're talking about us as a business buying something for the business. So that could be maybe a van for the business, or it could be anything else, you know? It's just a purchase. And okay, next is a discounts received daybook. And a discounts received daybook lists the credit notes received from suppliers when a prompt payment discount is used when paying suppliers for an invoice. Now hold up, wait, I know what you're thinking. What the hell is a prompt payment discount? Prompt payment discount, which is sometimes should displayed as PPD, is the same thing, and a prompt payment discount is literally in the name. So it's basically a discount received for paying promptly. So for example, if I was a business, and businesses usually have expenses, right? So I might we might have a terms agreement, right? That you buy this product for 30 days, right? But in the terms, I might also write, if you pay me within 20 days, I'll give you a 5% prompt payment discount. Now, why would I do this as a business? Now, let's think about it as a business, right? Let's put it into a real business situation, which I like to do. And you're going to find that out in this YouTube series that I'm doing right now. And yeah, so let's think about it in a business situation. The reason why you would want to do this is because as a business, cash flow is key. You have a lot of expenses coming at different times, and you having cash basically now is better than having cash later, because you could pay off those expenses. Maybe reduce the amount of interest you'll have to pay on debts, for example, and things like that, right? So having good cash flow is very important. So that's why a lot of businesses may offer prompt payment discounts to customers who decide to pay earlier, but they still want to give you good terms of like 30 days in order to be competitive, because that's what the competitors do, but still incentivize you to pay a little bit quicker while still not losing that business. So for the discounts received daybook, it is coming from the vantage point of you as a business, so the discounts that you have received. And that's why I have used the image of the shopping, right? So it's you, so you have to imagine you as a business going and you're buying basically like these items so right, to resell on your store, whatever, right? So the discounts received is you receiving these discounts as a business. So the prompt payment discounts that you have, right, and you have used when paying suppliers for an invoice, that is what has to be recorded within the discounts received daybook. Remember, discounts received means you receiving these discounts as a business. Now, the discounts allowed daybook, which is obviously shown here by the picture of them going yes, it's basically you as a business allowing customers discounts. So discounts allowed is you allowing customers discounts. So that's why it's called discounts allowed. And it's the credit notes given to customers who have used their prompt payment discount whilst paying their own invoices. So your customers using your prompt payment discount term, right? The terms that you've had in your agreement in the sale, and they have actually actively used it within their whilst paying for the invoice. And obviously that means that you had to give them a credit note for this, right? And you have to record that credit note in the discounts allowed daybook. So the credit note is that you've received from suppliers, you write down the discounts received daybook, but the credit notes that you are giving out, you have to, for payment discount, you have to put in your discounts allowed daybook. So remember, this is very key because a lot of people forget this. Discounts received is what you're receiving as a business. Discounts allowed is what you're authorizing as a business. Now, the last two that we're going to talk about here is the cash book and the pay cash book. And the cash book records payments and receipts in both the bank account and the cash account. So this is basically the money book. That's how you have to think about it. And it records the payments and receipts. And receipts is basically, you have to get used to this term in accounting. We use the word receipts a lot. And receipts, basically, I don't know why they use the word receipts, but it's basically just money that's coming in. That's literally what it is. So money that's coming in. So it records payments, which is money going out, and receipts, which is money coming in the bank account and the cash account. And this is recorded in the cash book. Now, the petty cash book records small payments taken, usually from a tin and jar, as we talked about before. And basically, the petty cash book uses those pay cash vouchers, records those pay cash vouchers into the pay cash book, sorry. So yeah, so it basically records. So that's why it records the small payments taken, because it it writes down basically what the pay cash voucher has already written down, basically, but it puts it um into a book, basically. Thank you guys so much for watching it until the end. I'm proud of you. Please, before you go, like, comment, share, subscribe, hit that bell icon. It motivates me to do more of this good work. I know when I started out learning AAT, there was no videos out there. I just feel like video format is the best way of learning. It's more interactive, it keeps it interesting with all the imagery. I'm going to commit myself to try and making better videos. This is my first video. Please follow me along with the journey so I can help you guys out. Comment on some improvements that I can maybe be able to make, and please share amongst your friends to share a new way, a better way of obviously learning. Yeah, thank you guys for watching it to the end. The first step is always the hardest. I'm proud of you guys, and yeah, let's commit to finishing our AAT exams successfully together.